It is November 15th, 2017. This video is going to explain how the stock market has been repeatedly crashing over the last better part of 20 years or so, and introduce a commercial offer, a special, if you will, about the Greedometer service that will allow you to see the Greedometer sequences between now and year end, which should be quite valuable. To the thousands of people that have been following and aware of and following the Greedometer and the Greedometer service for the past several years, a lot of what I'm going to talk about is not news to you. However, keep in mind that I am going to work my way through a bunch of examples of Greedometer sequences over the last 10 plus years, and I am going to talk about what's been going on this year in 2017. So stick with me. This is going to be interesting. Let's start with the broadest brushstrokes. This is the homepage for the Greedometer service. There's an interactive Greedometer here. It shows all 10 inputs to the Greedometer algorithm. The top 4 are live. In other words, you can play with them, and there you go, and watch the gauge move in real time. Ooh, that's pretty cool. VIX is now somewhere around 9 or 10. Grease WY is around there. Adjusted PE is somewhere around there. Profit margin is somewhere around there. And what do you know? Yeah, that's very exciting. Very, very, very exciting. Okay, let's get on with the show. Let's go very broad brushstrokes. The Greedometer data over the last, almost 19 years of Greedometer data shows a repeated situation wherein the Greedometers show a stock market crash is underway or initiating, and at different levels of maturity, and at different points in time, central banks manage to stop that crash. This is a graph of the time between all the Greedometer sequences measured over the last, since the first one in 2003. And what you notice is, first of all of these crashes have been stopped by central bankers, but the time between all of these crashes is getting shorter and shorter, to the point where it's reached 0. And I can only measure to a granularity of a week. So the time between sequences is now 0 weeks. This suggests that there's probably an end game that's about to unravel or unfold, and that probably central banks will not be able to stop this. Let's put this chart up for a second. This is from a St. Louis Fed website, very useful website. And what this shows in blue is total assets of U.S. banks, okay, growing over since 1973, I think it was, 72, 73, 73, and GDP, real GDP. So it started out that the ratio of U.S. bank assets to GDP was around 15-20%. Fast forward to the recession of 1990, it was around 30-ish% of GDP. Fast forward to 2001, the beginning of that recession, banks, relative to the size of the economy, or GDP, had reached almost 50%. Fast forward to the end of 2007, where the Great Recession started. Bank assets had grown to almost 75% of the economy. And to now, November 2017, this continues up to about here, that spread is about 10%. So bank assets relative to the size of the economy is now about 90%. For all intents and purposes, the size of the bank and banking system is effectively the U.S. economy. Now, looked at it another way, as bank assets are liabilities. It's for everybody else. So people, businesses, local governments, if they have debt, their debt or liabilities are assets to the banking system. So the system is increasingly borrowing from the future as debt grows, as debt relative to GDP grows. You're borrowing from the future. That just means the system is more leveraged, and when there is a crash, it'll be bigger and faster. Food for thought. I'm going to walk you through a few previous, a lot of the information on the website. I'll walk you through what's there and previous crashes. So let's go to the crash that everyone knows and remembers well, the crash of 2007-8-9. So this is how you get on the website. Go there, loads this page. This is the greedometer sequence, and this is the mini greedometer sequence. This is a video showing how to use it. And it's pretty simple in terms of the mini greedometer. This is what I call the baseline. This is what I call the top line. These are formed by, in red, this is the mini greedometer weekly readings, and this is the S&P 500 in blue. Here's what you're looking for. Whenever you hit a baseline point in the mini greedometer reading, the S&P 500 stops dropping and starts bouncing back. That's what's shown here, 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 etc. Okay. Top line is where it inverts the other way. Stops climbing and rolls over here and here and again here. As the video will show you, this is not a static system, it's dynamic. What do I mean by that? I mean that whenever the Fed takes an action to stop a stock market crash, it makes this flatter. It makes this line flatter and makes it approach this line as well. So that's what happened here. This video goes through it in great detail. Money where your mouth is. This is the ad that I ran in January 2009 saying the Dow would drop to the 6,000s a couple months before it did. I ran that ad before I had the greedometer. I ran that ad in January, I think February 2009 as well. So I did it, I only had the greedometer algorithm. I didn't have the mini greedometer algorithm, but it was enough to have a lot of confidence in that forecast, which is why I ran that ad, which was exceptionally expensive. In any event, but it delivered quite a lot of business. I've since sold that business. So that's that crash. Now, a lot of critics tend to look at this system and these algorithms and say, hey, anyone, big deal, right? The stock market's at all-time highs. Anyone can say there's going to be a crash when it's at all-time highs. Well, that was the case in 2007, wasn't it, right? However, it wasn't the case in 2010. In 2010, because the crash of 2007-8-9 had been stopped by QE being expanded and accounting rules being changed so that banks could be perceived as being solvent. I think I phrased that correctly. Anyway, back in 2010, some of you will remember the May 6, 2010 flash crash where the Dow dropped 1,000 points that day until they shut off the stock market, and then central bank liquidity jammed it back up again so that nothing had happened almost. Well, nobody saw this coming, right? Yeah, right. Well, so here's a great example. The S&P 500 had managed to climb its way back to 1,200. Remember, back in 2007 and in 2000 and in 2007, the S&P 500 was in the 1,500s. Okay, you get to May 2010, and it had climbed from the 600s, 666 actually, intraday low, back up to 1,200 in May 2010. And I'm like, well, nowhere near 1,500, point being. But at that point, you should have been expecting a fairly serious drop in the S&P 500 to come, and sure enough, as we know now, the Dow dropped 1,000 points. The S&P dropped 120 or 30 points intraday before being shut off for a minute and jammed back up. What was expected is in July for another baseline point to be seen that's shown here, consistent with around 30-something% drop in the S&P 500 from its peak. So pretty considerable. Anyway, another example. Let's look at 2011. 2011, there was a crash, and you say, well, hey, there was no crash in 2011. Well, there was. The Dow and the S&P dropped 20% that summer, pretty much right on time. This is what the greedometer sequence looked like. If you watch the videos, you'll understand how to use it. But in a nutshell, the SPIX was retesting a high seen back in March and April, and while this had happened, the greedometer values had plummeted, and this is the telltale sign for the greedometer, how you know a crash is about to initiate, or that there's a crash launch point. In any event, tighter granularity with the mini greedometer. You got the baseline forming rather nicely, coming back up to this point. Again, you're retesting with the SPIX, and then you should expect a meltdown. Now, what I did was in April and May of 2011, I sent Lots of emails to all sorts of folks in the financial press, saying saying a crash would initiate in July that summer, and that it would be brutal. How do I know it'd be brutal? Because this is way steeper than the baseline for the crash of 2007, 8, 9. Steeper means a faster crash. Money where mouth is. Since no one would listen to me, I ran this quarter page ad in the Wall Street Journal in early July 2011, saying there's going to be a crash. Was I right? Well, let's see. It dropped 20% and had to be stopped by the Fed and the ECB. Otherwise, it would have kept going. This was the next inflection point. This is consistent with probably 12 to 15%. Well, no, 20%. Yeah, about 20% drop, which is what it did. And then back to the top line. The next line, had the Fed and the ECB not intervened, we would have seen in September, October that year, would have seen about again a 30ish or so percent drop. Anyway, they did intervene, so that cuts that sequence to an end and grows the next bubble. Anyway, on with the show. It's been years and years of the same story. Fed, ECB, BOJ, all sorts of central bank action stopping stock market crashes. On the website, let's go back to, let's see, here, okay? Greedometer videos explains how to use the algorithms. There's that chart you've seen already and what it means. There's the video of the 2007, 8, 9 crash. These are very interesting. Spend a few minutes. Each one of these videos is 5, 6, 7, 8 minutes pretty much, and really easy. This is a very valuable video because remember the QE3 taper tantrum, quote unquote? Well, I mentioned this is a dynamic system. So whenever the Fed does something yummy or unyummy, then it necessarily has an impact and will be picked up by the greedometers. And what this video shows is when Bernanke famously threatened to begin merely tapering the QE3 program, we saw a steepening of that sequence. Then he backed away from it, and then back it went. So this is a very valuable video, which is what, 2013, I think it is. 2014 and 15, great examples again of mini greedometer and greedometer sequences showing the major inflection points in the S&P 500 and what central banks were doing to stop it. Another great example. So great educational exercises. That's again going on in what, 2013, 14. Fast forward to 2015. And this is going to be a very busy chart, but I'll walk my way through it. What I want you to notice is this. This was the Greedometer 10, mini Greedometer 10 baseline, estimated to be here initially, and got warped shallower and shallower and shallower and shallower all throughout 2015 and 2016 from our friends at the Fed, mostly. That's what's shown in blue. So the biggest influencers were arguably Bill Dudley, the New York Fed president, who's retiring early next year. Anyway, also Janet, and to a certain extent also Bullard from the St. Louis Fed. So back to this sequence. Again, this is really busy, so I apologize, but this is the estimated baseline. I say estimated because we didn't get a chance to see it. This is pretty much an average of the previous 3 or 4 mini greedometer sequences, so we know that's the right ballpark. Now, at this point, let's see, a couple weeks before this drop, this is August of 2015, right? This is when this got blamed on Chinese banking system beginning to blow apart a bit. That's what it got blamed on. In any event, just before this drop happened, I did a blog post. There it is there, August 18, as that drop was pretty much just getting started. I did a blog post saying it's going to get rough for the next couple of weeks. Why did I do that? Because I'd seen all this happening. This was warping, and then I was expecting a pretty sizable drop down to here. That was stopped by our friend Mr. Dudley doing an unscripted, unscheduled announcement saying that we probably won't raise rates next month at the next FOMC meeting. That warped the baseline flatter and thus slowing the crash from here to probably around here-ish. And then before this could happen, then also there was the delivery of no rate hike. So it probably warped it a little shallower, probably to about here. So we get to now, what, January 2016? Just before that, around here, I did another blog post in December of 2015. basically saying I'm in a big short. So December 28th, 2015, and the Big Short movie came out, which was awesome. In recognition of that, I thought it'd be time to announce that, you know what, I'm short again. And if you were a subscriber to this service, you would have seen all this happen. You would have seen all this happen, and you would have been loading up on shorts late in December, probably anywhere around here, and you would have been expecting that. Wait, no. And we're told we're told that nobody saw this coming. Whatever. So more actions from the central bank, mostly the Fed warping it slower throughout now 2016, and all the way we get to the election, and you can see things are melting down, beginning to melt down in a pretty serious way there too. So I was expecting the greedometer and mini greedometer is not political. I have no evidence over almost 19 years of data to distinguish or determine whether the policies of the Democrats or the Republicans are better or worse than the other. They're both fairly equally terrible. I think you could defend by virtue of the fact that we've seen Democrats and Republicans alternately in charge of the purse over the last 50 years, and this is what it's ended up with. This, by the way, this is bank assets relative to GDP. It's also debt, okay, relative to GDP, and this is where we are. So yeah, both have done a pretty crappy job. So now I'm going to deliver us to the election day. Now, election night, Mr. Trump was announced the winner. That night, the Dow dropped pretty close to 1,000 points, hit limit down. Limit down for the futures market means they'll shut it off. There's a self-preservation mechanism to the futures market and the main stock markets in North America, in the US. And anyhow, so that night, in less than 2 hours after it was announced that Mr. Trump had won, the Dow dropped about 1,000 points to hit limit down. The S&P dropped about 130 points to limit down in less than 2 hours. So what do? We shut it off. And then we use our spare billions of dollars of liquidity to buy S&P futures. Our friends at the Swiss National Bank and the Bank of Japan did exactly that. So by the time you woke up the next morning, you saw a little bit of red. And by the end of that day, the 9th, it closed pretty much flat to where it was the day before. So nothing to see here, right? And certainly if you look at a weekly or monthly chart that doesn't show hourly sort of damage, then there's nothing to see. There you go. Unfortunately for me, I took out a half-page ad in a local newspaper saying, basically, I don't care who gets elected. And I understand it ran November 9th, but this is the print newspaper, so I had to take it out. I had to put the ad together and take it out and book it weeks in advance. So I pretty much, this was the greedometer saying, I don't care who wins, red or blue. Either way, we're going to see a stock market, and we're going to see an opening salvo, a wake-up call we would have seen over the couple of weeks immediately after November 8th. We're seeing probably about a 25% drop in the 2 weeks following. Was I right? Well, what can I tell you? It was down 7% in 2 hours. So I like the chances that that would have been down 20-odd% in the next week or two. Anyway, such is the peril of stock market timing mechanisms. They are now subject to markets being shut off and jammed back in the other direction. That's inconvenient for people like me. Finally, being delivered to where we are this year. That's the election. See, you don't see this. You don't see the drop there at all because it's on a weekly close basis. The story we are collectively told or sold is that, hey, there's Republicans top to bottom, and they're going to give us unfunded tax cuts. No, wait a second. I think Republicans call it tax cuts, but what they really are is unfunded tax cuts. In other words, not paid for. In any event, that gave us this sugar rush rally in the SPIX through March, and pretty much what's been happening all year long is whenever the mini greedometer gets intro week, so before the end of the week, when it got to around 60, which is this level here, when it got to around 60 intro week, someone out of the Fed got spooked, got panicked, and it did an unscripted, hey, we're going to spike the punch bowl or something like that. Now in March, Mr. Dudley did no less than 3 intrusions intra-week to jam things back up. Now, you only get to see what the snapshot at the end of the week, but Intra week, before the end of the week, the mini greedometer values were 60 and a little bit under several times over that 2 to 3 week stretch. Seeing as that's for some reason scary, apparently to Mr. Dudley at the New York Fed, he announced, "Hey, we're gonna do something, spike the punch bowl, what have you." Next time it happened here in May. So Bullard came out and said, "Hey, more QE if needed." Next time was July. July. That was Yellen came out and said, "Hey, rates may not rise much further." Again, in both of these cases, all three of these cases, intra-week, before the week closed, mini greedometer values were around 60. Get to this point here in August, we actually closed under 60 in terms of a mini greedometer value. Dudley comes out again and says, "I don't see an asset bubble. By the way, we are going to begin tapering and we're going to begin normalizing the Fed's balance sheet, but it's going to take years. And when we're done, it's still going to be way bigger than the pre-financial crisis." So there you go. This is the same sort of thing that we saw previously with Dudley here and Dudley and Bullard here. Basically, they're intruding to stop a stock market crash. When they do, it warps the baseline shallower or flatter and flatter and flatter. My estimate where it was, and basically this goes back to September of this year, and we're in November. So in fairness to my paying subscribers, I'm only going to get as close as 2 months ago. But this has been the story all year. What's happened since then has been, since September, has been more a full court press in terms of we're going to get a tax cut, and it's going to be marvelous, don't you know? So we'll see. What's going to happen, and here's where the sales pitch comes in. So what's going to happen between now and year end is there is going to be a lot of excitement out of the greedometer and mini greedometer that will probably tell us a great deal about what's going to happen next year. There is a weekly service which has been temporarily put on hold. There's a daily service, the daily letter. It is for the most part targeted at money managers, be they pension fund, hedge fund, institutional money managers, people that can afford $5,000 a quarter for 5 user IDs. And also for some advisors that manage a rather large, advisors/stockbrokers that manage a rather large book of business. This is a hefty fee, so let me speak to this briefly. There's a special that I'm going to talk about next and show you where it is on the website. But in terms of justifying this $5,000 per quarter or $20,000 a year, let me just say this, okay? If you are an institutional money manager, you saw things melt down last time, and you know how painful it was. You can fairly easily afford that $5K a quarter. If you're an advisor or a broker with a significant book of business, how can I put it? Last time things melted down, you had to deal with many irate customer phone calls, and you know how painful that was. If you're a subscriber to this service, you will know when it's going to be a crash. You will see it happening, and you will have the opportunity to take evasive actions to limit the pain, if not outright profit from it for your clients. So there you go. Right now, there's a special. Through year end, you can have access through year end to the daily greedometer letter for $900. That's, I guess, 6 weeks or so for $900, which is a substantially lower rate than the $5,000 a quarter. So that's the sales pitch. Lots and lots of examples of central bankers stopping stock market crashes and stock market crash initiations. I think quite frankly, they're running out of bullets. And many of them are retiring. Certainly Yellen retires not far down the road, and Bill Dudley is also going to retire early. There you go. That's the sales pitch. All the best.